We will start today's session with a conversation with Tony Olivito from Comeback Capital. Tony, welcome to the show. Good to have you. You're on mute.
Oh, I'm on mute, sorry.
Now you're good. Go on.
Okay, how about now?
Yes, perfect. Go ahead.
Okay, good. Thank you. Glad to be on the show. I'm excited. I'm excited because I think it'll be a good conversation. There's a lot of similarities between, the advice, the guidance that you give entrepreneurs and the way that we invest. So thank you for having me.
Great. Let's get acquainted. So tell us a bit about your background as well as about Comeback Capital. What are you trying to do with Comeback Capital?
Sure, thanks. So background, I started off in corporate M&A for a couple of years, and that's where I learned about valuations and acquisitions and mergers. And then I spent a lot of years essentially as an operator working for a large private company, one of the largest in the country, worked in various different roles, supply chain analytics, finance, strategy, and then about 6 years ago, I started a microfluidic chip manufacturer with a friend of mine. So got into the entrepreneur world, and also around that same time started investing as an angel pretty actively. Fast forward to about a year and a half ago, and formed the Comeback Capital Fund with a different partner. And the name Comeback Capital is derived from a bus tour that was started by Ro Kahana, who's a representative from California, Tim Ryan from Ohio, and a bunch of venture capitalists from Silicon Valley who put together these bus tours of the Midwest, going to cities like South Bend and Detroit and Cleveland, Indianapolis, and they liked what they saw. It was kind of like their first foray into understanding the ecosystem here in the Midwest, and they liked what we were proposing and what we were doing individually, and supported the formation of Comeback Capital. So.
And what is the size of the fund?
So, we're a startup in a sense, right? This is our first fund, and it's $2.25 million. And to date, we've invested in 16 companies. So 16 companies in about 18 months. So pre-COVID, we were on a pace of about making one investment per month. We expect we'll probably make another 10 investments. Our check size is typically 100,000, but earlier stage company might be as low as 50,000.
Okay. And what do you want to see in your companies before you invest?
Yeah. So in terms of the stage of companies, so we invest in pre-seed and seed stage companies. So these are companies so at the earliest stage, pre-seed, typically, almost always, they're post-revenue. There's some form of traction, whether that would be, say, 5,000, 10,000 of MRR, paid pilots. So that's like on the earliest stage, right? So post-revenue is important. Because before that, right, if it's pre-revenue, that's where like the accelerators tend to do a good job, or there still needs to be it's in the entrepreneur's best interest to continue to bootstrap to get to that point, right, of a couple $1,000s in MRR, because it just makes capital raising a little bit easier. It's never easy, right, but it makes it a little bit easier, right, if they're post-revenue. In addition to that, we typically like small rounds, right? So we've invested in quite a few rounds that are as low as like anywhere from like 250 to 500,000, right? That's typically at the pre-seed. We will invest in larger rounds, like as high as 2 million, right? So that's our range. Anywhere, round size anywhere from 250 to 500, because again, we're covering pre-seed and seed stage. Capital efficient.
Do you lead rounds?
Pardon me? Oh, do we lead rounds? So on a small pre-seed round, we would lead, yes. Obviously, on a larger, like on a seed round, depends on how large the round is, right? If it's a $2 million round, we probably wouldn't lead that. But, if it's a seed round of only 750, that's something we could lead, right? Given our, like our check size is 100,000, but then our LPs, who are partners at other VCs, have the opportunity to sidecar, right? So as a group, Comeback Capital could provide, $400,000 or $500,000 in a round.
Okay. So talk a bit about sector. I heard you say MRR a few times. So does that mean that you're doing B2B SaaS primarily? What's your sector focus?
Right. Yeah, so it's primarily B2B. We do have a couple of companies that are, well, it's technology or tech-enabled services, right? So yes, we have a lot of companies in the portfolio that are, B2B software. We also have a couple, about 3, that are selling to consumers. And so those are transactional. But I'd say we weigh more towards the, B2B software. But we do look at both. I was using MRR as just something that people would recognize and to point out that, it has to be post-revenue. Obviously, like we invested in a company called Zana Workwear. It's workwear for women in STEM and manufacturing, right? So that's a transactional business. They're selling boots and other types of clothing. And so the model there, the valuation metrics for that type of business is going to be different than a software, right?
Okay, so let's talk about geography. You talked about this bus tour being the catalyst for founding this firm. Talk about what is your philosophy on location, geography, etc.
Yeah, so geography for us is the Midwest. And, so it started because we saw opportunity that there was a lack of capital in the Midwest. And, specifically in areas outside of big cities, like Chicago, right? There's a lot of capital in Chicago for stage. But if you look at our portfolio and where we've invested, right? We've invested in Milwaukee, right, which is not on a lot of people's radar screen. We've invested in companies in Indiana, Bloomington, Indiana, Iowa, Missouri, Minneapolis. Although Minneapolis, right, there's capital up there, but it's never really mentioned, right, in when people are talking about the Midwest, focus tends to be Chicago because it's a large city, right? So Ohio, Cleveland, for example, right? We invested in a couple of companies in Cleveland, right? So these are places, so it's all Midwest, and obviously it's because we're here in the Midwest, we understand the market, that's where our networks are, but specifically, right, it tends to be in kind of the smaller markets in the Midwest. We're not opposed to.
Where are you based?
Oh, sure. Yeah. So I have 3 other partners. I'm based here in Chicago. I have a partner in Cleveland, another one in Pittsburgh, and another one in the Detroit, Flint area.
Okay.
Yeah, and so we invested.
Let's go to some case studies, some companies that you have invested in, feel for what they're doing, and especially when they came to you, what did they have and what did you see in them that really compelled you to write those checks? And I'm actually very interested in some of these off-center geographies where you have activities. So take 6 cases from these off-center geographies.
Yeah. So what did they have when they came to us? Typically they hadn't raised a lot of capital prior
Yeah.
to us investing, and so that's important for us. If the company's already raised a decent amount of capital, then it wouldn't be a fit for us. It might be a fit for another venture firm, but it wouldn't fit for us, just given our thesis and where we want to invest. The team, right? So something interesting about the team, some proof points that they're able to execute, right? Because when you're looking at this early stage, there's just not a lot of data, right? I mean, we collect as much data as we can, right? But then you have to augment that with, we need to find some information to help us predict whether this team or these two founders, typically, right, two founders, can execute and can sell, right? So we've seen that they've built this technology, right? But how successful are they in having conversations with customers, right? Because the next stage, right, if we invest in them, typically that money is used to build sales and to grow, right? So the backgrounds of the founders, right? What their experience is in the industry that they're trying to sell into, right? Is important for us. So those are some of the things those are some of the key things that we look for. Capital efficient business models. We're not looking for unicorns, right? That's for other people.
That was going to be a next question that I would ask you. So let's go. Since you already have segued into that, tell me about what is your philosophy. You're not looking for unicorns. You're looking for early exits. Yeah,
exactly. So, my partner has this good example, right, that we use quite frequently. So if you're a founder, right, would you rather have 40% of a $100 million company or 4% of a $1 billion company, right? They're both equal, right? You end up with $40 million, right? But the probability that you actually reach $1 billion, right, is less than 1%. Yeah. So your probability of getting $40 million if you're trying to build a unicorn company, right, is much lower, right? So and if you look at where the exits are, right, the bulk of the exits are under 100, actually between 30 and 50 million, right?
50 million.
Yeah.
Bulk of the exits are under 50 million.
Right. So and we're trying to build a portfolio. We're looking for the companies that we think can build something that could exit, has a good probability of exiting in that range, right? If they go on to build bigger companies, right, that's great. But if you look at our portfolio, we maybe have like one or two companies that are kind of like on that track, but it's not like we're explicitly looking for those types of companies. Whereas I think there might be other investors out there, other VCs that specifically do look for those types of investments.
Right. So just a couple of questions, follow-up questions on that. What is the size of exit that you are aiming for? Is it sub 50 million, 50 to 100 million? What is the mathematics of your fund?
Yeah, so our fund, I guess, we're happy with more like what we say singles and doubles, right? So our portfolio, we're happy if we're able to identify a lot of companies that have successful positive exits, right? So I guess we don't need a lot of large exits if we've invested in companies that have, 3x or 10x or 7x, right? So so for us, again, like even a $15 or $20 million exit would be
Will work.
great if the company was capital efficient in getting there, right? If they only raised $1 million or $2 million, right, and they exited at $20 or $30 million, like that could potentially be right
perfectly fine
yeah. And you know, the nice thing about that is that entrepreneurs would in that instance that we just described, an entrepreneur would end up with most of that exit, right? As opposed to if raised a lot of money, right? If they had a big round, if they raised $5 million and exited at, let's say, $30 million, most likely they diluted themselves along the way, right? So, yeah. So capital efficiency is important.
Yeah, our philosophy is bootstrap first, raise money later, or not at all. So if you can, bootstrap, even if it's bootstrapping with a small amount of capital, sub $1 million capital, and you can get to an early exit, that's considered a perfectly fine outcome, which is what you're echoing here.
Oh yeah, absolutely.
Can you talk about a couple of examples from your portfolio that you think are good representations of the kinds of companies you like to invest in? Yeah,
so good examples would be, there's some diversity in the types of companies we invest in. Generally, if you look at the industries, from an industry or vertical perspective, it makes sense that they're in the Midwest or connected to the Midwest, right? Because they're happen to be in like logistics or supply chain, fintech. There's some fintech in the Midwest. Specifically for specific examples, there's a company called Exit 7C, which is the first investment we made. That's based up in Milwaukee, and they broadly are a company that does maintenance for fleets and different types of maintenance. It could be mobile fuel delivery, mobile car wash, tire repair, fleet maintenance repair. Commonality there is they do it remotely, and there's some technology that makes them efficient in doing that. Another company, let's see, Honcho. Honcho is a company that has created software for enterprises to monitor communications, and that's pretty important. Like today, as more and more companies are going remote, or they had to go remote. A lot of companies had to go remote, right, as a result of COVID. Yeah. And so they have, where in industries where compliance is important, like in financial industry, right, where information could be shared, insider information or things that would tarnish a brand. They have this technology to ensure that employees are communicating in a way that's consistent with policy and don't put their careers and the company's brand in danger. There's a whole variety, right? So that's more of an enterprise product. Ziptility is more of a SaaS for small utilities in the water industry, workflow management, some GIS capabilities. And then, so those are just a couple. And so we're not married to any one type of model, let's say.
Okay. Tony, I have a question about the activity level in the Midwest right now. If you look at these pockets like a Milwaukee or a Minneapolis, Ohio, Iowa, what kind of volume are we seeing? How many startups are operating in these kinds of geographies?
Yeah, so the fact that we were investing pre-COVID at one company per month, right, indicates that there was decent activity. We looked at we're looking at essentially 100 companies per month.
Okay.
And Yeah, so we're looking at 100 companies per month. We invest roughly in one, right? So it's like 1% of what we look at, we invest in. And so, in those cities you mentioned, right, they're building ecosystems. They're connecting universities to the startup scene. They're trying to connect angel investors and create micro VC funds, like governments are trying to sponsor and support micro VC funds in some of those states. So there's more activity throughout the Midwest. There's accelerators that are specific to industries in that state. For example, like Iowa and Nebraska have, as you would expect, agriculture-related accelerators. And Iowa is a big place for insurance, right? And so they actually have the Global Insurance Accelerator out in Des Moines, right? So in a lot of these cities, they're focusing on what they're good at, right? And that's probably because there's a concentration of a certain type of company in certain industries in those cities, right? And that's a natural place to start, right? To build an ecosystem. So so I mean, there is again, there is activity.
And the 100 deals a month that you are reviewing, what percentage do you think is that of the total total startup pool in that general area?
So I mean, we do eliminate some because they're out of region, but I would say that I'd say probably about 85%, 90% of those that we see are in region.
No, that was not my question. My question is, if you look at the entire pool of deals in your region, 100 deals a month is what percentage of that total deal flow?
So 100 deals a month in terms of like overall in the country, or are you thinking?
No, overall in the region that you are working in. So are there like 1,000 deals a month in that? I mean, what is the total pool of startups operating in your region?
Sorry. Yeah. So I guess how many deals are we missing, right? So I mean, if we're if that's like 1,200 opportunities a year, Midwest, there's probably a couple thousand, so that's pretty good coverage, right?
So there are a couple of thousand deals across all of these states. There are only a couple of thousand startups?
Yes, I believe so.
Oh, wow. That's interesting, actually. I would have guessed that the number has gotten higher than that, but that's very interesting input.
Yeah. So I mean, again, we're those deals that we're looking at, right, are coming from accelerators. Some are from universities. Some are from other co-investors, right? And so I believe that in the Midwest there's probably a couple thousand. I haven't gone back, and then so that's actually an interesting question, something I should delve into. But I don't think it's probably more than a couple thousand. I guess so. From a national number, right? I haven't seen numbers that focus specifically on technology company startups, right? Is it tens of thousands? I think 100,000 or so, right? And obviously most of it.
The national number is closer to 100,000.
Yeah. And so, right, and I've seen some numbers that 80% of that goes to 2 states, right? So that would mean that 20,000 is spread across the rest of the country, right?
Yeah, that's true. Yeah, that's true. California takes bulk of it. Interesting. Tony, I'm so happy to hear about your activities. As you can tell, our philosophy is, developing the ecosystem in a distributed fashion and really supporting a global startup ecosystem. So it's very important for players like yourself and your colleagues in the Midwest and other places to do their part in that effort, and that's how really a global ecosystem comes together. So it's terrific that you're doing what you're doing.
Right. Well, and I think it's important too that there's more people, more entities, more supporters that are focusing outside of those, two states that we just mentioned, right? California and New York, right? Because, there's great entrepreneurs everywhere, right? And and you can build a company anywhere, right? And so it's the focus on like how do you build a company? What does it really take, right? And now with technology, right? You really don't need to be in California because you have access to a lot of the tools, right? Developers.
Absolutely.
And so the focus
We've always been of the opinion that you don't need to be in California. In fact, you can't really support the cost structure of a place like Silicon Valley if you're a startup. It's just not viable to build very early stage startups with Silicon Valley cost structure.
So I think the focus shifts to how do you what problem are you solving, right? What niche are you going after? And it's really more about the product and why you have some type of competitive advantage, right? And are you able to, how well are you able to sell into that niche, right? What basis do you have, right? What experience do you have?
One thing, we're going to move on to the entrepreneur pitches in a minute. I just want to ask you for one thing. The companies that you're rejecting, not investing in, if they are looking for help, send them our way and we will, do our best to help them, because this is something we are very equipped to do, is figuring out why a company is failing to raise capital and what are the options of how to put one foot before the other and not go out of business.
Absolutely.
And potentially come back into a fundraising round after plugging those gaps. This is a very common scenario that we deal with.
We'll definitely talk more after this. Appreciate it.
Great.